Aditya Birla Group presents Budget 2015, the Make in India Budget. Co-presented by SBI. Fiscal State.
Welcome back to the Fiscal State, our special Indianomics edition to address the fiscal arithmetic of the upcoming budget. I've been speaking with Dr. Govidna, Dr. Subir Gokarn, Neelkanth Mishra and Sajjid Chinoy. Well, Sajjid, very quickly lay out the math for us. Where can the government find the money to pump prime the economy?
So I think a starting point, Latha, we've all said that the big theme from this budget is going to be greater public investment, and I agree with Neelkanth that the fixation from foreign investors will not be so much about whether the fiscal deficit is 3.6 or 3.9. The heavens won't fall if it's 3.9 as long as people are convinced that those extra resources are being used for significant public investment on the balance sheet. My own sense is that the composition of spending has become very adverse. Capital expenditure of the budget, which used to be 2% of GDP, rose to about 3 in the mid-2000s, is down to 1% of GDP. Now, there are limits to how much you can ramp it up. So in my estimation, given state capacity, given implementation capacity, I'd like to see another 0.5% of GDP in higher capital expenditure, whether it's railways or highways this year, and you need to find that space. We've all said that, a subject not spoken about is bank recapitalization, that's going to be equally important to make sure there are enough funds to recapitalize public sector banks to break the logjam in that sector. I would argue over last year, another 0.3% of GDP. And then, of course, you have the fiscal reduction in the deficit of 0.5%. So the way I look at it, what the government needs to do is find about 1.3% of GDP in fiscal space this year to achieve both objectives, higher investment and a lower deficit. 0.6 or 0.7 of that have already come, manna from heaven. It's oil subsidies. I've been arguing for a long time that the government should be doing an asset swap, very similar to what Dr. Gokarn said, that sell assets more aggressively and reap those resources and plow them directly into asset creation. So it's an asset swap on your balance sheet. If you can get 0.4 or 0.5% more in non-tax revenue from asset sales, that just leaves you to find about 0.2% of GDP in cuts in other expenditure, subsidies, for example, to square the math. But let me end by saying, I think this is the first full budget. People are looking for a vision. I think they're going to look for a paradigm shift, on higher infrastructure spending, a DBT road to subsidies over the next 3 years, more recap funds for banks. And so if that paradigm shift is achieved, I'm not sure they'll be too fussed about 3.6 to 3.9, though for me the perfect budget is to achieve both objectives simultaneously, more public investment and still adhere to your fiscal target.
Oh, you're becoming a bit of a fence sitter. Never mind. Neelkanth, where should it be spending? What is the best way to get a good multiplier?
Great point. So I think it's very difficult for the government to spend. I mean, they haven't spent for so long. I mean, I think they've lost the institutional capacity to spend. So when we were doing our math and we figured out that there is about 1.5 trillion rupees, 1.5 lakh crores that possibly the government can spend, we started thinking through, okay, so what can they spend on? The first thing that we came to was, okay, maybe national highways. And then you look through the numbers, there's 10,000 kilometers, 70,000 crores over 3 years. That's 25,000 crores. They already spent 11,000, so there's another 15,000 crores gone. Railways, they give 30,000 crores. Maybe they can make it 50, but I think the railways has an institutional problem in terms of being able to ramp up very fast. And then you are suddenly left wondering, okay, so what else? And then you necessarily have to encroach on state subjects. So there is a whole wide swathe of things that they can do. We've used 5 heuristics. And, generally prescriptive research is terrible for investors when you're turning your hopes into your forecasts. It's very tempting, but one should avoid doing that. So what we've done is, use 5 heuristics that the government may think important. The first, as you said, is a multiplier. You can't just buy solar panels. That won't have much of a multiplier. You need to be in short cycle projects because you can't be committing to a high fiscal deficit forever. You need to have shovel-ready projects. You can't be doing river interlinking and bullet trains. You need to adhere to the manifesto. And you need to invest in areas where there is institutional capacity to ramp up very fast. So as I said, railways, traditionally you would think it's a bottomless pit, that it's always starved of funds. If you give them 1 lakh crores, they can spend it. But they can't spend very fast because one, they've not been spending for a while, and two, there is the institutional bureaucracy that has to go through it. I personally think that the best way to spend, and this is where I'm really doing prescriptive stuff, so the chances of going wrong are very high, is they should spend on housing and they should spend on rural roads. Because one, these are things, and especially the housing, given what China went through over the last 5 years, and the aftermath is a bit undesirable, but if you go from 3 trillion to 9 trillion GDP, having 3 bad years after that, I don't think is that bad an outcome. And similarly, the US 2001-2006. Now the US model was clearly too risky, ninja loans and all that. I think the Chinese model of state investment in low-cost housing was actually perhaps not something that will work in India. So an interest subvention on 15 lakh or sub 15 lakh houses, construction tax, service tax waiver in construction, possibly even a capital gains tax waiver. And suddenly thousands of contractors all over India's towns become active. You start seeing demand for cement and steel. Similarly, rural roads. I mean, the way things work, or even rural housing, Indira Awas Yojana, you can name it whatever you want, but if you give 15,000 crores, you build 1 house a village. You give 45,000 crores, you build 3 houses a village. There is leakage, but that leakage again gets spent in the economy. It doesn't go to a Swiss bank account. Okay. So I think rural roads, rural housing, urban housing would be the best way to stimulate the economy.
Okay, well, I don't know how much the government's bandwidth or administrative capability will be to deliver on what you are saying. But yes, as you're saying, perhaps a goodish bit of private sector involvement through interest subventions and capital gains tax exemptions on low-cost houses will perhaps bring home the booty. Well, actually, running out of time. So very quick, one word from all of you on what you would consider a great budget. Which number, percentage of capex to total GDP, what will be your definition of a good budget? Very quickly, Dr. Gokarn.
I think 3 things. One is a theme, a kind of a vision, a roadmap for the next 5 years or 4 years, whatever is left of the term in terms of budgeting process. We need to know now what the government is thinking of over the next 3 years. We don't want to see, or I wouldn't want to see a one-off budget, a one-year budget with no sense of a longer-term commitment. Second, we've talked about expenditure reform, reducing subsidies, and bringing technology as much as possible into the delivery and monitoring of subsidy and welfare schemes. And third, very importantly, keep to the deficit, but take the spending, the capital expenditure of the budget, put it into a firm balance sheet, and that means creating a new institutional mechanism to do that. We should not be mixing capital spending, which is critical, with fiscal consolidation, which is equally critical. We have to find a way to separate the two.
Okay, well, I have much less time for the two of you. Neelkanth?
Much more streamlined expenditure for the states. So really, the spirit of federalism. It could be much fewer CSS, centrally sponsored schemes, and also a capex to GDP, which could be going up from a non-defense, going from 1 to maybe 2.5% of GDP.
Okay, Sajjid.
3 very quick numbers tactically. I mean, I would like to see the fiscal deficit adhere to 3.6. I think the state doesn't have the capacity to increase non-defense capex from above 1 to 1.5. So anything above that would be unrealistic. And third, on the revenue side, let's finally have realistic tax to GDP assumptions. So if you get realism on the tax to GDP ratio, you get a capex number of 1.5. and you get a 3.6, that would be, for me, would be the best of all worlds. And I think that's possible. A, because of the windfall savings from oil, and B, with a little bit of boldness and creativity on the asset sale front. So that for me would be the perfect package.
Okay, and finally, Dr. Rao, very quickly, your definition of a good budget.
Well, I would call a good budget is the one where you have substantially, in fact, you have adhered to the fiscal targets that have been set. You have not done some creative accounting or you have not done, spilling over of the expenditures into the future or taken advanced taxes of the next year. And you have substantially pruned your revenue expenditure so that quite a lot of it goes for the capital expenditure, and the capital expenditure ratio substantially increases.
Okay. We are completely out of time, but really I think all three of you are looking at similar definitions in terms of higher capex, adhering to the 3.6%, at least three of you want that, and to have realistic assumptions of revenue growth, and Dr. Gokarn chipping in with a better longer-term vision and perhaps some out-of-the-box ideas for funding infrastructure. Gentlemen, out of time, but thank you very much for joining in this special edition on the upcoming budget, The Fiscal State.
Aditya Birla Group presents Budget 2015, the Make in India Budget, co-presented by SBI. Fiscal State